We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Jensen, mining executive and metals analyst. How are you today, David?
I'm well, Tom. Great to talk to you again.
It's really great to have you back, David. It's been quite a while since you and I have spoken, but I really remember our conversations fondly, and for a while it's almost like you fell off the map. We were, I think we did a Twitter Spaces together. We did one interview together, and I really found you an interesting resource in the metals sector. And since then, you've been kind of blocked from Twitter as well as LinkedIn. So why don't we start by talking a little bit about kind of where you've been for the last year plus here.
Yeah, I basically was unceremoniously dumped by Twitter and LinkedIn. I made the egregious error of posting medical research studies during the COVID panic about ivermectin, and that was apparently enough for both LinkedIn, which was my professional platform, and Twitter. And by the way, I reapplied to Twitter, and they said they had reviewed it and that I was not allowed back on, and it was not appealable. And that was after Musk took over. So clearly, freedom of speech but not of reach is a thing. And I was, I had kind of lost those platforms where I'd been sharing information. So, but it's great to reconnect with you. I'm now posting on Substack, where I can put videos and articles up, and I do a mixture of both. Try and change it up a little bit. So hopefully I can connect with some of your audience there as well.
Yeah, I mean, that's a big thing, that a big reason I wanted to have you back is to kind of give our audience the ability to reconnect with you and your work, because again, you do a lot of interesting work in this area. You've been posting a lot on Substack, Gab, Getter, Telegram. So your work is still out there. It's just in different places for people to be able to find. And I hope we can give some people the links and they can reconnect with you, because a lot of your work I've found very interesting.
Well, thank you.
You sent me an article that you put a lot of work into. You made a video and a Substack about it, really explaining why Jamie Dimon appears to be frightened here. So that's going to be the topic for today's discussion. And of course, we're going to jump off into a bunch of different directions based around, what he's seeing, what we're seeing. And really, I think these are all symptoms of something that we all know at this point is somewhat inevitable, right?
Yeah, we seem to be reaching the end of new tricks. And I guess with goods price inflation rising the way that it has, it takes away a whole series of sleight of hand tricks that the Fed can use in terms of liquefying the markets and taking away problems by printing money for a period of time. So it's let's just go through the slides and see where the discussion takes us, and hopefully we shed some light.
Absolutely, David. So what are some of the symptoms here that Jamie Dimon seems to be kind of pointing at? It seems to be all within the last month, if I'm not wrong, right?
Yeah, I have a couple of slides ahead. Do you want to just walk through those and we can systematically walk through this? But the root of it all, to me, is economic downturn in the face of continuing inflation, if I wanted to summarize it. Mm-hmm. So the CPIU is running like 4.1%. That's the Urban Consumer Price Index. And it's still running 4.1. And yet we're seeing signs of an incipient heavy downturn in the economy. And given the amount of money printing that's gone on today, like the Fed was notionally going to tighten now. But how do you tighten when everything's heading into an economic downturn? And I think the thing too is that the credit bubble that's been created by the Fed needs the continual liquidity. There's a famous saying that you can't taper a bubble. Mm-hmm. And, I think we're in that position right now where they're trying to reduce the liquidity, but we're seeing signs in the housing market and a whole series of other places of that it's causing quite drastic impact on the economy and on citizens. And I think that's the problem that he's looking at here, is that these, an economic downturn, while you need to tighten, which is potentially very powerful, and also the fact that these assets, and I'll touch upon that at the end of the presentation, but that the assets of the banks are likely at risk because of the withdrawal of this liquidity, not just in North America, but from overseas as well.
Right. So what's the next slide here, David?
So just a first slide here to show you the social media platforms on which I present my information. Mm-hmm. And then, let's just start with this one here. So this is what we've seen here in the last 4 weeks here. And it's notable. He's the CEO, Jamie Dimon's the CEO of the largest US bank. It holds $3.9 trillion of assets. And because of his stature in the US financial system, it's, the JP Morgan is almost looked upon as an arm of the US Treasury, or vice versa, some would argue. But his warnings and actions have meanings. And there's three things that have happened that he's done in the last 4 weeks that gets our attention. So let's just take a look at those. So September 26th, he came out and said that the economy is on a sugar high. He could see rates could hit 7%, and in his discourse, he said that he just didn't think that the U.S. economy was set up to take these higher rates. Mm-hmm. So that was on the 26th of September. And then on October 24th, this was really shocking, when he came out and said that the central planners at the Fed were dead wrong, 100%. And ultimately that they didn't know what they were doing. And those are pretty powerful words, mm-hmm. right? You look at these major banks are shareholders of the Fed, and the Fed basically acts in their interest, and that he should come out and attack them publicly like that, to me was, really eyebrow arching.
Well, and as you show in the next slide, I believe it's not just his words, right? It is, he's following this up with actions.
Right. So selling stock, right? Put your money in the bank, in my bank. My bank is good. I'm going to sell 140 million of stock, right? There's kind of a break of the logic link there. So that was the third thing, October 27th. He first says the Fed doesn't know what they're doing, and then, I'm selling stock in my own bank, 141 million worth. Mm-hmm. So, to me, this signals fear that he's doing this, because, as I said earlier, it's highly unusual, selling stock, like he's voting with his feet, and it appears he's trying to extract wealth before what is the question. It'd be interesting to know if he's going to actually leave his money in the bank, or he's going to buy other things that are outside of the banking system. And the reason I'm saying that is back to this point here. The fourth line here is that the banks hold 2% of the cash of their deposit holders. So it doesn't take much to cause a liquidity crisis with the banks. And if you see that the screenshot there below, it says the banks don't hold the cash, we're told. That's another video presentation that I did, and you can find that on my Substack. So the banks do hold about $4 trillion of the $82 trillion that they owe to their deposit holders at the Fed. But the problem with that is that if they withdraw that cash that's on deposit with the Fed, which the Fed, by the way, just printed up and gave to them, is very kind. After 2008, they've basically credited their accounts and gave them $4 trillion of cash. The banks are earning $200 billion a year of interest from the Fed on that right now, which is a nice situation.
Mhm.
But if they withdraw that cash and get it back into circulation again, it's going to have an impact on price inflation in the economy.
Mhm.
So we've already got elevated price inflation, and the last thing you want these banks to do is to go to the Fed and try and pull out some of these deposits that they have at the Fed, both because they're going to lose income and because if consumers or savers, withdraw some of that $82 trillion of deposits and put it into circulation in terms of buying assets, they can cause a rapid onset of price inflation.
Mm-hmm.
And, just to give you a sense is that the real assets such as commodities and precious metals, et cetera, they're less than 5% of all the assets out there. So you take money from savings and start buying real assets, and you can inflate the price of real assets in the economy very quickly. And what that would do is in a very short period of time, it would unveil the amount of money printing that's gone on by the Fed for decades. So, and not only that, but it would drive interest rates much higher, which would compound the problem in the economy and bring down the credit bubble at the same time, right? The economy's been made dependent on cheap credit here over the last 35 years as they've run this credit bubble and ramped it up.
So, one thing there to kind of tease out, did he not make a very interesting comment to, I believe it was a journalist or somebody like that, about holding cash in a JP Morgan bank account, to your point earlier?
Yeah, and I think that might be on the next slide. That's on the next slide here. Yeah, so he said, he made a comment. There was a journalist that said that, he might, wouldn't he consider moving money from a JP Morgan bank account to, I think it was UBS, which had a higher capital ratio. And Jamie Dimon said, well, that's why I'm richer than you, because you'd actually think of moving your money out of JP Morgan. So it will be interesting to see if he keeps his money in his own bank and does what he's advocated for other people. And I guess the biggest question really is, like, why is he anxious? Like, why is he moving money out of stock? Why is he giving these warnings all of a sudden? Mm-hmm. And I think we can look at some of the indicators here and get a sense of what might be driving some of this fear. There's a whole series of things that we can see, and I think that they may well all be compounding together to kind of have him effectively raising the alarm in the financial sector. Mm-hmm. So one thing here is the leading economic indicators, like the Fed is raising interest rates, and we're supposed to be in a phase here where they've done their job in responding to the post 2020 panic, and we can see here with these leading economic indicators, it's the blue line here. And you can see here how it's turned down into a highly negative area, and that it's of a level that's always led to recession in the past. So even though the GDP is notionally still positive, we can see that we're heading into an area here where they're going to need to apply looser monetary policy. And yet we've already got 4.1 consumer price index growth in the year over year measures. So, and remember here too that we've had this increase of the M2 money stock. They increased it by 42% over 2 years, and there's an Austrian economics measure called the true money supply, and that's that true money stock is up over 60% in 2 years, and yet we have the economy turning down so heavily now. So that's one indicator. The other indicator that's interesting is that we're seeing this run up in large corporate bankruptcies. So that's starting to run up now as well, after the Fed has only tightened here for a year and a half and only raised interest rates up to to 5.25%, 5.5%. As I mentioned here, we would expect it with the higher interest rates, given the amount of leverage, the amount of total debt, in the system. And we'll see that in a subsequent slide as well, Tom.
So, David, just a quick question on that. We're talking about Jamie Dimon seeing 7% rates, and I think there's a slide that there's another guy that's seeing even higher rates than that.
Yeah.
Is this due to the Fed actually raising their target rate to that, or is it the market deciding that there is no longer a need, and consequently the yield on those bonds goes up to that level? In other words, how much control does the Fed really have around the interest rate?
Yeah, well, very little. It it sets the overnight rate, and when they run, pardon me, when they run QE, they print money and buy the bonds to create false demand for the bonds, to keep the demand high and the interest rate low. But the problem that we have right now is that we see this goods price inflation as high as it is, that if the Fed was to restart QE again, I think it's very likely you'd see $150 or $200 oil in a very, very short period, because of the signal that it's sending in terms of the debasement of the currency. The Fed has already done a lot. It's already printed a lot of money. It's already injected $8 trillion into the economy during the last panic, and given the banks those large deposits that they hold. And if they were immediately going to have to print money and buy assets again to fake the values, which is what they're doing in the vernacular, it's advertisement to the world of this. They're embarking on a failed strategy again. Mm-hmm. And I think that has a lot to do with it, right? The Fed sets the overnight rate. If it uses QE, it can affect the longer term rates, but given the high goods price inflation, it really limits what they can do in terms of controlling the interest rates again. And that's really at the heart of the matter, given the giant mountain of debt that we have in the system right now.
Mm-hmm. Do you think we're going to be entering a time? I think this is a perfect graph to show it here.
Yeah.
The 70s, we really had 3 waves of consumer price inflation. Right. And as we, progress here, it has almost been, touted by the Fed that they've, they're kind of thinking that they've won the battle on inflation.
Right.
However,
Krugman did a victory lap there a couple of weeks ago, which actually caused me extraordinary concern.
Yeah, I mean, putting the hubris of that aside, yeah. there are numerous examples throughout time of, perfect markers of, the magazine covers that say inflation is dead. All of those ideas. It seems to me, I was looking at, and I've brought this up several times in the past couple of weeks, about the renegotiation of auto workers' salaries. Jumping by 25%. It really seems to me that we are seeing the seeds be sown for another wave of inflation here yet.
Yeah, I mean, when you do increase the money stock, which is the total amount of money, the money supply is the annual change, and the money stock is the actual money in the system. So when you increase the money stock, the inflationary consequences, they happen in almost a tidal fashion, right? They ebb and they flow, and so it happens unevenly. And the thing is that they can't raise the money stock once and then just stop, because of the continual requirement with a credit-based currency system that you're always expanding the money supply. So I think what we're seeing, this is a really good chart now to touch on, is that the blue line there is 66 to 82. And we can see the inflation rate there on the right side. So it went up to 14.5%. That's on a monthly basis. And on the left side, you can see we've got a slightly lower rate of inflation now, with the dotted orange line or the dotted red line, but that it's following the same cyclical path. And what's interesting is that we're into the point now, because of the credit-based nature of the currency and the monetary system, is that they need to start reinflating again. And and that the danger here is that we start heading into a very inflationary period again, with even higher interest rates, which is going to have a very rough impact on this credit bubble based economy that the Fed has now created over the last several decades.
Yeah, I think there are several problems that I think obviously are going to all come to a head here.
Yeah. Yes. So this is the 1970s, right? This runs up into the mid 80s and through the 70s. And what we can see here, the red line is the M2 money supply, so the annual change in the money supply, and the blue line is the consumer price index. So what you see is these waves where you have a wave of money, and then you have a wave of price inflation after a lag, another wave of currency creation, followed by a wave of consumer goods price inflation, another one followed by an even higher level of inflation. And this is where 1980, where they raised interest rates to 19%, and it came plummeting down. They had a spike in money supply there because things had slowed down so tremendously. But ultimately, the inflation rate came under 5% there, up to, I think this goes to about 1990 roughly. So you can see the kind of like that almost like counter-cyclical moves there, right? Of the money supply versus the goods price inflation. Now, what is it?
Kind of speaking to the idea that of lags within the economy. Yeah.
So like 2 to 3 year delay in the juice versus the consumer price index moving up as they added liquidity into the economy. So it's been interesting because since 1987, Alan Greenspan took over the Fed, and everybody was raving during the 1990s. I remember Wall Street Journal articles raving about the great moderation, and we hadn't seen inflation. And you can see here that the red M2, that they did drop the money supply down in terms of its annual growth. But then they raised it back up again going into 2000. But it's interesting because even with a 10% increase in M2, we didn't see the increase in the consumer price index, which remained under 3% for virtually all the time until recently. Now that there is the Boston Commission and the restatement of what consumer price inflation really is, the implementation of hedonics and a number of other measures, which compared to the 1970s and early 80s measure, understated the impact of inflation relative to the measure back then. But the fact is that the value remained below 5% for virtually the whole time. And we didn't have this run up in goods price inflation until here after 2020. And you can see M2, that they increased it to 27% year over year. So that's the amount of money that's in the economy is increased by the M2 measure by 27% year over year, and over 40% in a 2-year period. So it's no wonder that even the suppressed CPI measure started to leg up here and move up over 8%. And it's gone down, but now it's starting to move back up again for the CPI the urban measure. So why is that? Why did we not have goods price inflation? I think we see it in the next one. There's a number of things, but number one, and I think this is critical, and there's people that will discount it, but I think it's essential to understanding it, is that gold and silver, the amount of money in the system in terms of the money stock in the 1970s increased, by 2.3% from 71 to 1980. And the price of gold and silver, gold went up by 21 times and silver went up by 24 times. And what we had in 1987, and I cover it in this presentation on my Substack called The Bank of England Central Bank Gold Price Rig Now Leads to Global Collapse. And the reason that might sound a bit alarmist, but when you look at it, what essentially gold and silver were critical warning systems for the excess increase in the money stock or money supply by the central bankers. And so what we had was basically the restatement of the CPI to a dumbed down version, which was difficult. It was difficult for it to respond. And the second thing was in 1987 that the Thatcher government at the time, with their big bang reform of the financial system, gave control of the London gold and silver markets to the Bank of England, which was behind the formation of the LBMA, which is the London Bullion Marketing Association. Mm-hmm. And what they started to do then at that time was they legitimized the trade of these unallocated spot contracts. So what they did was, instead of requiring you to have a bar of gold to trade a bar, an ounce of gold, or a bar of silver to trade a silver contract, was that they just went to a promissory note basis, which was, I'm going to trade a spot contract. I'm going to give you a spot contract, which is immediate ownership. And I only need to deliver metal into the exchange if you demand delivery, which happens less than 1% of the time. Mm-hmm. And what we saw then was that the daily volume of gold trading, for instance, in 2014, they did a survey in 2011 called the Local London Liquidity Survey, which looked at the London bullion market and the levels of trading of spot contracts relative to what they posted daily. They posted a net settled a daily summary of the ounces of gold and silver traded. But they discovered that the net settled amount that they were posting was less than 10%, less than 10% of the total volume traded. So in the end, it ends up that when you look at the figures, like in 2014, they were trading 2.5 times annual global gold production from mines in a day in the gold market.
Just to play devil's advocate, though, David.
Yeah.
There is a role for hedging within the market.
Yeah, but you do that with futures typically, right? This is spot market. So spot market is immediate ownership. It's a contract that gives you ownership of metal.
Right. So really is there a role for, this derivative trading within the spot market?
Well, when you've got a market, it's a supply and demand price discovery mechanism. Mm-hmm. And what you're doing by using these promissory note systems, you're creating the ability to create infinite promises. And what it does is, as that scales up, which it did after 1987, it scaled up over time to the point that they're trading immediate ownership in the market of 2.5 times annual gold production. It's basically completely destroyed the ability to discover what true supply and demand for the metal is.
Right.
And the other thing that it gives them the ability to do is that as long positions build up, where the stop losses are below the current price, where traders are forced to sell. Mm-hmm. Because the bullion banks are basically holding the positions of the traders who are trading. So the bullion banks have full visibility of where the traders' positions are. Mm-hmm. And what they can do is they can create, for lack of a better term, but infinite supply and pound the market. Just sell till you hit the stop losses. Mm-hmm. And that forces the traders to sell, and it blows them out of their positions. And that's how you can contain the price.
Right.
You can create infinite supply to meet demand as long as people aren't demanding delivery of something real.
Right. So is this dynamic more dramatic within the silver market?
Well, that's an interesting question. I'll post something on that. I have done it actually in my Substack. You can go back and look at it in terms of the dynamic in the silver market. But the silver price trades in lockstep with the gold price when you increase the gold price, or you set the gold price to the power of 2.5. So when you exponentially increase the gold price and then plot it, so what they're doing basically is setting the silver price to trade at the exponent of 2.5 times the daily gold price moves, which gives you a very, very radical volatility of the silver price. So there should be no correlation between gold and silver to that extent where it's trading in lockstep. And it does it for 6-8 months at a time. And then it breaks for 3 or 4 days. Mm-hmm. And then it goes back into lockstep trading again. It's no wonder that people call the silver, and the media is calling the silver the devil's metal. It's not really metal that you're looking at. It's promissory note trading, which is the devil's instrument. And so, yeah, absolutely. Silver trades at an unbelievable level of volatility relative to gold, but it falls into complete lockstep when you raise the price of gold to the power of 2.5 and compare it to the daily silver price. So
interesting.
Yeah, so we've got the one element of the containment of the price of gold and silver, the restatement of CPI. And the third element here, if you can see it in the yellow line here, is the S&P 500. And so now it's at it's up by 650% since 1990. And the bond market's up even more as they ran interest rates from 19% down to zero. What they did essentially was they buried the monetary inflation in the financial markets. Mm-hmm. And so they called this beneficial inflation, right? So
well, it's beneficial. It's beneficial asset inflation for those that had the ability to be involved in the market. Right.
So we had massive monetary inflation, or currency inflation, really, if you want to be technical about it. So there's massive creation of currency by the central planners, and it primarily went into financial assets, into bonds and stocks. Mm-hmm. And the problem that we have now is this reappearance of goods price inflation. And you can see here that it went up to 8.5%, and then it dropped down below 4%, and then now it's starting to creep back up again. You can see here just at the very right of the curve. Despite this incredible contraction of the money supply, first huge increase, and then you don't see this kind of negative level of the money supply going back for very many decades. So, and here's a graph going back to 1988. You can see it clearly here. The dark blue line is the true money supply, or the true money supply in an Austrian measure, and the gray one is the M2. So they correlate in terms of their movements, except for during the early 90s. But you can see here the tremendous amount of currency that's been injected, and then this sudden contraction. The thing to mention here too is that the economy, when it's exposed to this amount of loose money and credit creation with a credit-based currency system, is it becomes dependent. The distortions that get built into the economy, it's almost like a drug that's fed into the economy, and it becomes dependent on this continual expansion and availability of loose money. Mm-hmm. And they shot for the stars here, and now they're very roughly contracting it in a very rough manner. And mm-hmm. I think that's further raising the concerns of Jamie Dimon here, is that we've got these bubble markets, both in the bond market and the stock market, and all of a sudden this free money, the liquidity that we're enjoying, is being suddenly taken away. So another indicator here, after all this loose money, is if we look at this graph here of the real disposable personal income, we're told that the economy is growing at 4.9% here in Q3 and how great things are. But we can see here that it contracted on a quarterly basis. It contracted quite strongly, and that it's turning back down again. And when we look at it on an annualized basis, this is the annualized basis here. We can see how the real personal income is in a heavy contraction here, approximately -6%. And we can see why people are suffering, right? Prices are rising. We've recently had 8% price inflation. Now we've got 4.2% by their numbers. And the real personal disposable income is contracting so heavily because of that. So it's causing people to suffer. And the rising rates are causing problems with the ability to carry this debt burden.
Can we just go back 2 slides quick and just talk a little bit? Yeah, that one right there. We're told GDP is 4.9% in Q3.
Yeah.
Is it possible that that is, an artifact of the inflation that we're seeing? It's not necessarily growth, but we have, on a nominal basis, sold higher priced goods or even the same amount of goods at a higher price.
Yep.
Not really actually resulting in growth, which is kind of an artifact of the way that this is calculated. However, it looks great because it's quote unquote growth, right?
Yeah. So, I mean, that's true. And one of the reasons for that is the fact that they're not, I believe, properly accounting for what the actual goods price inflation is. So because you're like, real disposable income is supposed to be disposable income after inflation's removed. Mm-hmm. And yet we're seeing this starting to turn down now again. And so I do think that, we have the inflationary impact that's starting to affect people, and also the fact that I think that the economy is starting to slow down now that they're contracting the availability of credit. It's a credit dependent economy. Like there's no real organic growth. What's happening is that they're expanding the amount of credit in the economy, mm-hmm. Which is increasing at multiples of the rate of the GDP increase. Mm-hmm. So you're let's say doubling the credit in a year, and you'll only get half of that increased in the GDP. That just shows how ineffective they are in running this credit-based economy, that it's become a credit on, air quotes, growth on, but only at a fraction of the amount of credit that you're creating.
Well, and I think that speaks to the ineffectiveness or the waning effectiveness of injecting that much liquidity into the system and having the effect that you need it to, right? That's right.
The distortion becomes so great that it doesn't. I mean, if they had used this type of monetary policy in the 80s, the economy would have gone completely ballistic. But the economy is now so credit dependent, and you can see it in this graph here.
Right.
Is that you've got $96 trillion of total system debt. So a third of it is federal debt, and the other 2/3 is corporate, consumer or individual debt, and municipal and state debt.
Mm-hmm. And of course, that doesn't include entitlements or anything like that yet.
Right. So you've got this. Yeah, this is debt in the system. Yeah, there's like another 200 trillion. I mean, I have a friend who says that they used to reserve trillions for astronomy, right? And the numbers are just so great. A trillion is a million, right? And we've now got total system debt at $96 trillion. And when you do a shock rate increase like this, the effective Fed funds rate now is about 5.25%. You're adding, I mean, the federal debt, it's got an average duration of 3.7 years. So it takes time for it to reset.
And to roll it.
Right, into the new interest rate regime. And, people have fixed rate mortgages, some have variable rate, but a large amount of the credit is variable rate or short-term credit that now resets to a much higher price. But what they've done by introducing this level of interest rate, which they've been forced into because of the price inflation, mm-hmm. which itself was caused by the radical increase in the money supply. But what it's done essentially is, with time, you're adding a $5 trillion a year interest burden to the economy from where it was here up for a long time when they were running the 0% policy. Mm-hmm. So, you got a $25 trillion economy and you introduce a $5 trillion burden to it, you can see quite quickly that the math doesn't work out, right?
Well, and I think this graph is interesting as well to look at I believe, I can't quite see it there, but it looks like the year 2000, when they had a fairly substantial rate increase, and how long they were actually just over the next one. I guess it might be 2005.
Yeah.
Yeah. And how long they were actually able to keep rates at that level before ultimately, reversing course as fast as they could.
And also that the rates go lower and lower with time, mm-hmm. until now. Right. It's a higher high now. as opposed to a lower high each of the times previous.
Mm-hmm.
And so it's very radical what they're doing, and it's extraordinarily destructive to an economy that they've created, which is completely dependent on credit.
Mm-hmm.
And I'm sure that Jamie Dimon's seeing things in terms of default rates, et cetera, on their portfolio. And these banks hold such a tiny amount of their assets in cash form. It makes them very vulnerable to their deposit holders. Right. And on top of that, when you recognize that the FDIC in the US and the CDIC in Canada, which provide the insurance on these bank accounts, like they hold, net assets of about 0.5% of the deposits. Like, how can they possibly provide, real or factual insurance coverage for these deposit holders when they hold such few assets? And
I think in a way that also kind of comes down onto our shoulders as citizens. If you understand these reserve requirements that the banks have, and it just makes me shake my head and think, like, who would want to keep any type of substantial amount of money in a bank?
Right. We've got the point where citizens look at the sticker on the door of the bank and assume that that's good.
Mm-hmm. Right.
I'm safe because there's a sticker on the door.
Well, my bank now has a gold-backed or partially gold-backed sticker on the door, which I may or may not have had something to do with.
Right.
But that's a discussion we've had before on the podcast.
It's confidence building that there's a sticker on the door. Never mind the annual report of the insurance corporation that insures you.
I was going to say, how about the FDIC insured sticker? That should fill you with confidence.
Yes.
Which, I mean, to this point again, we pay attention to this stuff. We see it. There was one bank failure on November 3rd, another one, which was a relatively small bank, but yet nonetheless, this is just another symptom of these shocks that are being exerted by these higher interest rates.
Yes. The Federal Reserve released in February of this year, the Board of Governors just posted a link to a presentation that they received in September of 2022. Mm-hmm. And that presentation, it revealed, first of all, Silicon Valley Bank in September of 2022. So it failed 6 months later. But in September of 2022, that Silicon Valley Bank had lost 110% of its banking capital.
Wow.
So it was fully bankrupt in September, and people didn't figure it out until the Board of Governors posted the link. And then if, people with good financial advisors actually read the presentation, said, get your money out. Mm-hmm. And the other thing in this presentation, which was interesting, was that it said that there were 700 US banks. I believe there's 4,500 different banks in the US. There was 700 of them in September of 2022, when interest rates had gone, was about 2.5% at the time, that there were 700 banks that had lost more than half of their banking capital at that time. They didn't say what the extent was, just that it was more than half. Mm-hmm. And I saw an article that estimated in May of this year that it was over 2,000 banks that had lost more than half of their banking capital. So, the banks, they hold these stocks and bonds and other assets, loans on their books, and they don't mark them to market. And so they can continue on in a state of denial, and it allows the deposit holders to continue on in a state of denial, having, full faith in the stickers on the door until it comes home to roost. And I think that's what's happening right now, is that there's enough evidence of the degradation of the quality of the capital that the banks are holding, and the extraordinary leverage that's in the banking system, and the tiny amount of actual cash that they hold relative to their deposit holders, mm-hmm. is it doesn't take a very big move in the value of their assets to create a distressed situation for the banks. And I think that's what we're seeing coming ahead here. But yeah, so this slide here is just, for me, is if you want to get down to like the single biggest problem that we have right now is this, I believe. is the extraordinary amount of leverage and the impact that the increase in interest rates is having, not just on the economy, but on the banking system itself. So given these interest rates are rising, right? You see it rising up to 5.25%, and everybody's waiting for the rates to go on. Now, Jamie Dimon says they're heading to 7%. Rick Santelli did a really interesting presentation on CNBC, and he said they're heading towards 13%. Mm-hmm. And then we get this counter statement by Janet Yellen saying that they're headed below 1%. So given the current price inflation environment, it's difficult to see. She says their baseline model is rates below 1%. So it's difficult to square that.
No doubt.
And my view is that even if Jamie Dimon was 7% is right, it has an extraordinary impact on the quality of the balance sheets of these banks. Mm-hmm. Extraordinary, because you're going to start to see this ramp up. S&P Global is estimating that the high yield corporate bonds, junk bonds, are headed to a 5% default rate by the end of the year. But that's not a guarantee of any sort.
Right.
And I think it's going to head materially higher than that because of the corporations that are dependent on this continual credit cycle and refinancing at low rates to continue these. And this relates to the misallocation of capital and the distortions in the economy that are built by cheap credit. Is you get these entities that are completely dependent on free money. And when you take away the free money, the cave starts. And I think that's what we're starting to see now. Mm-hmm. So kind of an actual net look forward on a net basis.
It's interesting to see the disparity in those two statements. And again, kind of going back to that idea of hubris that we have seen by magazines and
yep,
media outlets like that.
Yep. Right. And the establishment economists, right, celebrating the defeat of price inflation, even though they've had this massive injection of this fiat currency into the system, which is debasing the currency. Mm-hmm. And now as they try to take away some of that rate of growth, they're actually not withdrawing. They're reducing the rate of growth, right? Mm-hmm. So the net amount is still highly positive.
Right.
You've still got 37% more M2 in the system, and you've still got 60% more TMS or true money supply, money stock in the system. So, a short-term contraction or reduction is not going to take away the price pressure. Mm-hmm. And
the distortions in the market that has caused.
Right. And by doing that, they're introducing this specter of default. And I think that's the big bogeyman that's going to come, and it's going to visit some reality on these bank balance sheets. So look forward. What I'm seeing is rising prices will continue and elevated prices will continue. It's going to drive rates higher, which is what Jamie Dimon's saying and what Rick Santelli is saying. Citizens are going to continue to lose their real disposable income. They're going to suffer on an increasing basis, and they're not going to be able to service the zero rate debt that they carry because it's no longer 0% effective rate. As a consequence, bonds and stocks are going to start to correlate positively, and they have started to correlate positively as they did in the 1970s. And we're seeing that now arise in the last year, where bonds and stocks are moving up together and moving down together. It used to be risk on, risk off was the argument, right? Mm-hmm. Risk on was high stocks and air quotes safe bonds. would fall, and then vice versa, right? The bonds would increase in value, and the stocks would fall as people piled out of stocks into bonds, and they kept them running back and forth between those two repositories. And so when stocks and bonds move down together, and people see bonds as these certificates of confiscation, which is what they called them in the 1970s, when you read the papers from back then, is that we have terribly tiny sector of real assets, of things that have inherent value, that's not paper-based, right? So food, energy, precious metals, etc. You can have this sector of the economy, which is financial assets, a reallocation of the 95% of the markets, which are financial instruments, moving into the 5%, for argument's sake, of the sector of the financial markets, which is real assets. And then you can have all of a sudden this enormous tower of financial markets showing itself to have been created by currency inflation, and then all of this currency creation, debt-based fiat currency creation, run by the central planners since the 1980s. All of a sudden, the air quotes beneficial inflation shows itself to be what it is, which is entirely destructive. Mm-hmm. And what they were doing was artificially inflating assets, and what Rick Santelli calls the paperization of real assets helped to suppress their price and their apparent value for a period of time, just as the London bullion market suppressed the price. They stepwise, with time, took away the requirement to have contracts that were written in the spot market underpinned by real assets. They took that away, so you basically created artificial pricing structures. And then, so what you have then is when you have rapidly increasing price inflation, and we've seen it in many countries around the world. I mean, Turkey currently, they went over 100% price inflation. What it leads to in the end is a currency crisis, as confidence and trust in the currency is lost. And I just want to leave a couple thoughts here, but Venezuela had a currency crisis in the last few years, and you can buy with an ounce of silver, buy a month's worth of food. And Argentina in 2002 had the peso crisis. And during the peso crisis, they had a 70% deval in a couple of weeks, devaluation.
Wow.
And what happened was that the stores that had real goods for sale, they shut down, mm-hmm. because they're like, we don't want that stuff for our real goods, because how do we know there's not another 70% deval happening? Mm-hmm. But I mean, the wheel has to keep turning in the economy. People need to eat, and you need fuel. And so street vendors got set up within a week to sell fuel and food. And the primary unit of exchange was individual links of gold necklaces. That's what happened, a reversion, mm-hmm. right? Immediately in an emergency, there was a reversion back to trading gold and silver for goods, because gold and silver have a 4,000-year history as money, and they're units of fair measure. Right? There's been a war against fair measure by the financial sector, because fair measure prevented them from having a party. And now what's happening is these units of fair measure are going to reassert themselves when it's revealed that this was just, it was an inflationary market that was created by currency inflation as opposed to real growth. Mm-hmm. And yeah, it was a chimera, a multi-decade chimera created by loose money policy. One other note here, just in closing here, is that there's an issue going on in Japan here. This is an announcement from last week that they were going to introduce 4.6% of deficit spending this year to address inflation. So they were going to embark on extraordinary steps on a federal level to juice the economy to address inflation. And yet we know that goods price inflation is caused by monetary inflation. Mm-hmm. I think what's what hasn't been released yet is Japan's Q3 GDP, and it's expected to be negative. And I think that they're panicking a little bit there, or a lot, to take this step. And it confounds you to read that they're going to print money to address inflation, but I guess nothing should surprise us. It brings forth the whole issue of the yen carry trade, and this is the interest rate for the 10-year Japanese government bond, the JGB. And you can see here's the zero rate, 0%. So there was short periods where the 10-year government bond even traded in a negative interest rate territory, which means that if you put your money into a government bond, at the end of that 10-year period, you get the money back minus 0.25%, which is quite something. But what it did was the yen carry trade has existed. Just let me show you. Yeah, let me show you this. This is the 1-year bond before I go to the carry trade. So you can see here in the 1 year that it traded at, for a long period of time, at a negative rate. There's 0%. Mm-hmm. And you can see it's just breaking into the positive now. But the 1-year government bond for a long period of time traded at a negative interest rate. And what that did was that the bank rates in Japan are related to the government bond rates, and it created the availability of extremely cheap credit in Japan. And so that led to the yen carry trade. Now I'm using the 10-year treasury rate, but just remember that for a long period of time here, that the 1-year rate was negative. But you can see here that Japan ran materially lower interest rates than the US did. The red is the US Treasury. The blue is the Japanese government bond rate, mm-hmm. interest rate or yield. And you can see how much the US rates have risen. Now, what the yen carry trade typically consisted of was borrowing money in Japan at cheap rates and then investing them in US markets just on the spread between the interest rates. If you're borrowing at 0% in Japan and you're investing in a 5% government bond in the US, you essentially get 5% of free money, right? All you need to do is be able to hold that till for the term of the bond, and you would get the interest over that period of time. And if yields were steadily going down over the period, which they did here, is that you could actually sell that bond during that period for more than you bought it for, just on the basis of the fact that the interest rates were falling. It would create value to the bond. So above the 5% yield which you were getting, you'd get more money for the bond because interest rates had dropped in the meantime. But what we see here is that since 2020, the rates bottomed on the US Treasury, and that they're up in the 5% range now. And just note here that if you're holding a constant maturity 10-year Treasury bond, a move from 1% to 5% would cause a 30% decline in the value of that bond if you went to sell it. Mm-hmm. And so what we're seeing right now is that these hedge funds, which were borrowing here, and in reality, they were borrowing at near 0%. This is an illustration of the spread between the yields. But if you're borrowing on a 1-year basis and you've got a 0% cost of capital, what you could do is borrow for a year, invest it in the bond in the US, borrow in Japan at 0, invest in the bond in the US, get the interest, get the higher price of the bond, and get out and make free money. And what's happened now is with the sudden turn in rates in the States, that these funds, hedge funds, and banks likely as well, who had been borrowing for cheap and making free money, are now facing tremendous losses. And this is the old problem with borrowing short and lending long, right? When you borrow on a short-term basis and you lend on a long-term basis where you can't get your money back if you need it to pay off the debt that you've incurred. And all banks, by the way, operate on this model.
I was just going to say that. Yeah.
Yeah. And so I think that's another thing that Jamie Dimon is seeing here. And the problem that we may be facing here, I think it's highly likely that we're facing, is that as these interest rates start to go up even more steeply, that the hedge funds and banks who have borrowed for free historically are all of a sudden having to pay for the money they've borrowed at the same time as their assets are declining in value. This spike in interest rate reflects on a constant maturity basis, a 30% loss of your investment.
Mm-hmm.
And so I think it's important that Janet Yellen misled the markets the way she did. She thought it was likely important too, is to keep these hedge funds. I'm sure many of them have blown up out there that just no one's saying anything. And I'm sure their risk managers are trying to force them to sell these assets to cover their losses. But they're hoping and praying for the return to 1% capital that Janet was talking about.
Well, that'll be an interesting situation to see how it resolves.
Yes. So, I mean, the Japanese carry trade, the yen carry trade was estimated about $1 trillion in 2007. I've seen one inference from a Wall Street Journal article that estimated it was between $2 and $3 trillion. So,
and what time period?
Currently.
Wow.
So, I mean, if it's anything of that order, and these funds start to sell at large losses, you're going to start to see them blow up.
Mm-hmm.
Because the assets that they've held, if they've borrowed short at a 0% rate to invest in long-term treasuries, and those treasuries, 2, 5, 10-year treasuries have lost that amount of value, and they're forced to dispose of them in the market, it'll become visible.
Mm-hmm.
And then you'll start to see these a sequence of these funds and banks start to pop. So it brings us to the final point here about what do you do? Well, the key is that the entire financial system has been destabilized by the leverage introduced by the central banks. And I think there's a problem even in holding stocks in gold companies in brokerages, because the brokerages are dependent on their bank accounts, and the banks have been destabilized themselves. And I think that Jamie Dimon wouldn't be saying what he's saying unless the banks had been destabilized. So I always like this chart in terms of the gold lease. Now, the gold lease has come down to 2% recently, but I think you can expect that to go right back up again. But the lease rate is what a trader has to borrow the metal for. And 3% was roughly the peak rate in 2008. And it only hit it for 1 month. But we've seen elevated rates here for more than a year relative to historic norms of the lease rate.
And just for some context, David, when was the last time that rates got up to and over 3%?
2008. And that was just for 1 month.
Mm-hmm.
So, and then after that, the gold price went up by 2.5 times. Now, the lease rates, the 2 and 3 month tenor are in this elevated range. Even the 9 month is, you can see it's up in here in the 2.75% range. So as I said, over the last 4 days, it's dropped down a little bit, but I would expect it to go back up again. So some entity has dropped the slug of metal into the market to affect the lease rate.
Mm-hmm.
But I think if you look at it on a secular basis, you can see what the trend is here. And it's exactly what we would expect to see, is that the real assets that hold intrinsic worth and value become more rare as the paper leveraged assets basically show the destabilization that's happened, and that this wasn't actually beneficial inflation at all, but it was a series of bubbles blown that gave tremendous wealth to the financial sector and allowed the governments to run these deficit spending programs and fight numerous foreign wars with money that they could create from nothing. So I think in the end that you're going to see this move into gold and silver, energy, oil, natural gas, coal, etc., metals in general, food, fiber, timbers, et cetera, commodities overall.
Mhm.
So, and as I mentioned earlier, the problem is the scale, right? You've less than 5% of the assets are real assets, and it doesn't take very much. If you double the investment in commodities, you don't double the price of the commodities. You can send them up by 5 times. Right. Double the amount of money chasing an asset can drive it absolutely to the moon.
Mm-hmm.
So final slide, Tom, is keep this in mind. I think it's going to become a much greater awareness in terms of the public when we start seeing that the financial institutions have been destabilized and the insurance corps that have been put there to tell us that they're insured are shells, and that people are going to start relying on themselves and trusting units of fair measure again, which I can't think of better. I can't think of better assets that are units of fair measure than gold and silver. Mm-hmm. And I guess in closing, that I view that the entire war has been against fair measure since the introduction of the promissory note trading system in London in 1987 by the Bank of England. The money printers were given control of units of fair measure, and then were able to run globally loose monetary policy when those. To give you an idea, that not at the time, 90% of daily gold trade, even up till 5 years ago, 90% of daily physical gold trade was in London. Mm-hmm. So a key market for price discovery.
Right. I was going to say, David, that I think that's a great place to kind of put a bow in today's conversation. And basically all of your information is everywhere under Jensen David or David Jensen. So Substack is Jensen David, Gab David Jensen, Getter Jensen David, and Telegram Global Political Events as well, right?
Yeah.
David, I want to thank you for coming on and sharing your view on this and putting those dots together, really showing why Jamie Dimon is worried about what's coming. And I appreciate your time in taking to put this together.
Well, thank you, Tom. I really enjoyed the conversation. I might just close with a thought that if you're on a ship and you see the skipper walking around weeping, you might ask a few questions.
Yeah, that's a great way to put it. Absolutely. David, thanks so much for your time today.
Thank you. It was my pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.